Okay, it looks like we are live here. Do my standard checks, make sure everything's okay. Sound check, everybody. You don't have to say anything, but if you ever log into the live streams and the sound is wrong, hopefully that comment section starts lighting up and I can fix everything while we're going. So thanks everybody for coming in. Just as always, I'm just going to wait a few minutes for more people to show up. I do notice that in the first 3 or 4 minutes is when people start rolling in. So just give everybody a few minutes here. Hopefully everybody's having a good day so far. Markets are reasonably cooperative in the last couple of days after last week's massive VIX spike, GameStop stuff. Yeah. But we're going to be talking about volatility ETPs today. Okay, good. Sound is good. Looks like my comment section's pretty good. If it sometimes looks like I'm a deer staring in the headlights, it's because there's always a delay on my end. There's always about 20 seconds between whatever you're doing and whatever I actually see. So I don't know how to fix that. I've asked a few other people that have done streams, and theirs is similar. So I think it's just a YouTube stuff. It's fine. Doesn't bother me. I just get a little delay. If we ever were to do something that's actually live interaction, I've heard people talk about Discord and things like that. That's when you would want to make sure that it's absolutely live with no delay. But for video, doesn't seem to matter. So while I'm waiting for people to roll in here, I'm just going to play my little 1-minute intro, a little bit of housekeeping. It's very short, just 1 minute, and then we will immediately get into the volatility stuff. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff, I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, thanks everybody for watching that and for showing up today. Got a decent number of people, but from my very limited live stream experience, I do notice that more people come rolling in. So I don't want to just sit here and wait. We're going to go ahead and get started. So what I wanted to talk about today is volatility ETPs. Now, depending on what type of investing you do, I just put out a blast on Twitter and Facebook, so it's possible you don't really know that very much about them, but I gather probably a large percentage of people watching are interested in the vol ETPs. And, you know, you've got strategies where you're trading volatility on the short side and the long side, but again, most people watching probably default more towards that short vol side of things. And so it is very important for us to have reasonably good data. Oh, my camera just clicked for some reason. Everything looks fine. Sorry, that startled me a little bit there. No, everything looks fine. Start screaming at me in the comment section if something's wrong. My camera just did some strange noise, so hopefully everything is fine on that end. But yeah, it's important for us to have realistic data for how far these volatility ETPs decay, right? It's not the end-all be-all volatility metric. In fact, I don't really take it into account that much. I go much more into detail. But knowing how much the products decay is definitely important. And I do say decay because as we also know, long term, as long as the markets are staying reasonably cooperative and maintaining some sort of stability, volatility will be bleeding down. And that will cause these ETPs like VXX, UVXy, and the old delisted TVIX, which we'll talk about as well. It does cause those to decay over time. So what is that actual decay factor is what we're going to get at today. And I will give you the exact answers. But first of all, we have to remember that what it is all based on is this underlying index. Okay, this is the Ep.5 STR index. And all of the long volatility ETPs and the short inverse ones, the vast majority of volatility ETPs on the market are essentially tracking this methodology of this underlying index. So what this index does, just really quickly, I do have videos on YouTube explaining this in far more detail, but essentially this is a methodology of holding a combination of the front 2-month VIX futures. So if we go to the VIX futures term structure here, these are the front 2-month futures right there. None of these other ones matter. We are just looking at these front two. And that Ep.5 STR index is holding a composition of these two futures, depending on how many days to expiration there are. So right now, we're basically mid-cycle. You can always go on the ETF website. This is the iPath website. Over here, you can just type in VXX, and then it'll give you all the data that you're looking for. So you can just go highlight this VXX, and we can actually get the index components. You can see right now, it's pretty equal on both ends, right? It's holding 47% of February, 52% of March. It's basically right in the middle. So right now, what we call the VX30 contract is basically right in the middle of these two. Now, depending on how that product moves around in relation to this VIX index as we approach expiration, that underlying index, the Ep.5 STR, is going to be changing value. That's what's causing the price movements of this index. And then, of course, by proxy, because they're all using the same methodology, all of the volatility ETPs will move in relation to this as well. Not exactly. Don't get confused to think that the numbers should line up. The absolute value numbers will be different, but the methodology is exactly the same. So the question is, and I think it's an important one, is how much do these products decay over time, right? So that Ep.5 STR index, as you saw, it does go through periods where it can go down substantially. Now, what we're looking at here is a 1-year chart, and you can see over the last 1 year, it's actually up money. So to say that volatility ETPs always decay, or even most of the time decay, might not be entirely accurate. It depends on the market condition that we are in. Right now, in the last 1 year, this is actually up substantially. We started last year in February, it was at 27.11, and right now it's at 31.49. But if we go out 3 years, we can start to see that decay come in. Minus 17.6% annualized over the last 3 years. So essentially the 1 times index here has an annualized return of minus 17.6% per year. If we go out 5 years, now we can start to see why we call it the decay factor. This is now down 45.79%, and this is roughly in line with the long-term averages. If we go out 10 years, it kind of bottoms out around this 45% level. That's how much the Ep.5 STR index long-term decays per year, about that 45% level. So, the question today is, just take your best guess before I actually get into the data here. What do you think it decays per day, right? We know per year the thing looks ugly most of the time, but some years it can do very well. And during certain market environments, it could have several years where it does very well. The idea that it always decays and you should just short vol all the time, just cover your eyes and short vol, it's a crazy concept because we can go several years where that thing is trending upwards and actually spiking upward. But long term, just your best guess before I reveal the answer. And typically we can't really think too clearly on 1 day timeframes because it's going to be a small number. So 5-day time period per week, what do you think that underlying index averages as far as decay factor? I don't want to reveal it immediately. I want people to sort of participate a little bit. So what's that weekly decay in your opinion? Johan says 0.1% daily. Daily's hard to conceptualize sometimes. That's a pretty good guess. says, I think you already answered that. It was about 0.5%. So the difference, of course, is going to be whether we're compounding arithmetically or geometrically. Investment returns always compound geometrically. So here we go. We will reveal the first little piece of information. Because as we know, volatility ETPs themselves look very ugly on long-term charts. So this is the VXX since inception. A little bit easier to see on a logarithmic chart. A lot of reverse splits there. And then since the VIX futures launched in 2004, this thing's gone from about 400,000 down to 17 bucks. Obviously pretty diabolical. And then the same thing here with UVXy, this time from 641 million down to 1090. Right now it's about $11. And then the old delisted TVIX, our old friend that's gone, not my friend, it was my enemy. I told everybody to just ignore this one. But it delisted in July. It went from 19 trillion down to 112 bucks when it was delisted. So pretty terrible. But as far as actual compounding decay factors, let's look at the underlying index. This is the Ep.5 STR index. Again, this is this index, the baseline for all of these volatility ETPs, at least the front 2-month futures. There are a few of the ETPs left that do the midterm futures. So that would be, focusing more out here on the VIX term structure. But most of them are front month products. So this underlying index actually decays minus 0.235% per day. What does that look like on a long-term chart? We can see it here. The blue line, this is the underlying index on a logarithmic scale since VIX futures launched on March 26, 2004. So if we just do a basic regression here, minus 2.35%, that's what it looks like. Now, obviously, there are some periods where it decays faster than that. And again, there can be extended periods of time of multiple years where it decays significantly slower than that. Above, below, above, below. We're only really interested in averages because this is a baseline. If we go over to a 5-day chart, this is the one that's a little bit easier to conceptualize because I know some people do trade on the weekly options. Some people do monthlies, so we'll show the monthly in a second. But on a weekly basis, it is decaying minus 1.168%. So about 1.17% per week is what we're looking at long-term average. Again, could be more, could be less, but that's a pretty good number to have in mind, right? If you were doing a weekly strategy, for example, you'd want to know if it's just an average week, what you could actually expect to see the decay factor. And that's about what it is. If we go to the 21-day, which is essentially a monthly, if you're doing the monthly cycles, this is 21 trading days, down minus 4.815%. So nearly down 5% a month. And then when we compound that geometrically, of course, it adds up to roughly 45% a year bleeding capital. So that is the 1 times underlying factor of the SPVIX STR index. And I typically like to look at the numbers on a 5-day period. So we're looking at minus 1.17% per week. That's how much that underlying index decays long term. Of course, in the last 3 years, far, far less than that. In the last 15 years, that's what it equals. So is that more? I'm just going to glance at the comments really quick. Is that more or less? Yeah, Johan says 0.6 weekly. That's basically right on there. That's Brian says 0.5%, VXX minus 2 point. Yeah. So I don't know if this is a surprise to many people. What I find on Twitter, a lot of people don't actually talk about the VXX nearly as much as they do the UVXy. So we can now go into the UVXy, which is a 1.5 times leverage factor of this underlying index. It's essentially the same thing. I'm going to show you a chart. The actual decay of this chart, it follows the exact same methodology. This yellow line is the UVXy. So it will mirror on a 1-day basis exactly the methodology of the underlying index, just at a 1.5 times leverage factor. So now we will look at the UVXy. And this one decays minus 0.423% per day. Again, this is what it looks like on a long-term chart. We've got the UVXy all the way back to 2004, starting at 641 million, and now, of course, decaying all the way down to $11 today. And that is a geometric compounding of minus 0.423 per day. Again, the weekly is a little bit easier to conceptualize. So on a weekly basis, it is minus 2.1% decay factor. Okay, so every week, 5 trading days, this is what the long-term average is. Again, very important to remember, some periods it's less, some periods it's more. This is a long-term average. And then on a monthly, 21 trading days, minus 8.5% per month. So this is why a lot of people talk about the short vol trade, is that long-term, we are looking at a decay factor here. Now, again, it is extremely important for people to remember that those spikes can be violent and they can basically end your trading career if you're not careful. So just shorting undefined risk options is obviously a terrible idea. This is why I always talk about that, because just because the long-term average shows significant decay doesn't mean you're not going to get caught in something that really ruins your month or year or several years of your trading. Now, one thing I will talk about quickly, because I do get a lot of emails, I get a lot of comments. A lot of people, for some reason, and I suspect I know where the reason is, the number that gets thrown around a lot is that UVXy decays 5% a week. Now, like I said, I suspect I know where that is coming from, but it is very important to understand that that is only something that you will see on Twitter. Of course, there's no basis for us to think that. So what I've done is I've also prepared a little bit of a test here. What would a volatility ETP look like if it actually did decay 5% a week, right? So just doing a basic regression, 5% a week. Instead of starting at 641 million, it would have to start at this number. Now, that's a lot of zeros. That's a very big number. Obviously, 5% is just miles off the accurate number. Right? A lot of times on Twitter, that's what gets followers, is when you do tweets that have data in it. People, they follow those tweets. They think, wow, this guy must know what he's talking about. But nearly never did they actually open a spreadsheet and check their numbers. It's just plucked out of thin air. But this number is called 70 quintillion. That's how much of the decay factor it would be if we were actually talking about 5% a week. So here we are at the actual number, minus 2.1. This is 641 million. We have to add 11 zeros to get to this quintillion number. So I don't want people out there thinking that this is actually a legitimate number, like somehow the UVXy decays 5% a week. That is, it's absolutely miles off of the accurate number. Sometimes it drives me crazy when people just make up data just top of their head. But yeah, this is not even remotely close. So the one way that I can actually show that, we remember our old TVIX, right? The TVIX is a 2 times leverage factor of this underlying index. So surely, I mean, that's the most powerful product we've ever had on the market. It was delisted, but if we look at TVIX decay factor on a daily, minus 0.63. Again, this is a delisted product, but important to look at what a 2 times leverage factor would actually look like. So now, remember, this is going from 19 trillion down to the delisting price of $112 at minus 0.63% per day. That is massive, massive decay. On a weekly basis, the TVIX decays minus 3.1%, which is obviously insane, going from 19 trillion down to $11. That is, that's pretty crazy. On a monthly, minus 12.42%. So we're talking about a decay factor here that we're not quite sure that we're going to see it again. There is a listing for a new TVIX. There's, the passing regulations and see if they can get it launched. I'm not sure if that's going to really fly here. The TVIX was a very popular index, but as you can see, a minus 3.1% weekly decay factor. The problem there is people look at that and they think, well, that's a great product to be short vol on. The issue is there's always a flip side to that. And anything that can decay 3.1% a week can obviously spike insane amounts, 1,500%. It can spike 2,000%. If there was some type of flash crash, this could be career ending for anybody who is even close to undefined risk options. So obviously, always remember there's 2 sides to these decay factors. But that was just an illustration to show you that obviously minus 5% is a completely ridiculous number. Even the TVIX was only minus 3.1. And again, the UVXy is minus, where's the beginning? Minus 2.1. So that's probably the number that you can go baseline, the weeklies, minus 2.1 for the UVXy, and then the underlying index will be minus 1.17. So one interesting thing we can do with these numbers, and again, this is not really very much to do with how I trade volatility, but we can just get some general baselines. So right here, this is the VXX. It closed yesterday at 18.19. Right now, it's a little bit lower than that. It's already down quite a bit today as well. But let's just do closing values. It closed at 18.19, and the one-day decay factor is minus 2.38%, minus 0.238%. So on a long-term chart, if everything goes as expected, based exactly on long-term averages, we can expect the VXX 1 year from today, next February 2022, the VXX could touch $10, right, based on long-term averages. And the actual exact number, 9.97. So next February, if everything is an average year, we could actually see the VXX dip below $10. On a chart, right now it's at 1736. My chart doesn't go that low. So if it's an average year, 1 year from now, this could go down into the tens, which is kind of interesting. I wouldn't base any of your trade decisions on this. But again, like I said, it's just interesting data to have and useful to always have the accurate information. So if you're interested in UVXy, for example, just to see what that's at, yesterday UVXy closed at 1172. So if we put 1172 here, and then the decay factor, of course, is different for UVXy. It's actually this number, minus 0.423% per day. Remember, the weekly is minus 2.1. What can we expect from UVXy a year from now? Well, if we go down to the year from now, we can expect it, based on long-term averages, to get to $4 a year from now. That is very, very significant decay, of course. Now, with the UVXy, with all the volatility ETPs, they will do reverse splits. Typically, $9, $8, somewhere in this range, they would be looking to do a reverse split. We can look at the split history and just scroll over here. I've got a lot of data to go through. The UVXy split history, you can see there's been 9 of them. I would expect the next reverse split to be about a 1 to 5. So what would happen is, as this product is decaying, sorry, my spreadsheet's very, very slow here. As this product is decaying, if everything goes based on normal decay factors, let's just ballpark it right when it hits 9. What would end up happening is they would do a reverse split, a 1 to 5 reverse split, and that would be a $45 ETF, and then it would start from there. So at the end of the year, we could expect next February, if everything is just law of averages, we could expect the UVXy to have an actual print price of about $20. Now, again, that would be factoring in one of those reverse splits that have happened so often that have taken the product from $641 million down to $11. But that's basically what we're looking at there. So kind of interesting here. You can actually, once you have the correct data and you've got the numbers, everything adds up, then you can start getting realistic expectations for where this is going to go. So for example, if you were doing leap options on some of these products, you were doing a year out or something, and you wanted to know if it's an average year, where would the price be expected to be? Well, as we saw, VXX a year from now, we're probably looking at an ETF that's priced at about $10. And it would be looking at that point, or at 9, 8, to be doing one of those reverse splits. The UVXy, if the stock market is a totally normal year this year, and it just decays normally, almost certainly there's going to be a reverse split. They're not going to let that go down to $4. So you will see a reverse split there. So I always find this data interesting. As you can see, my spreadsheets are just packed full of stuff. But again, it bothers me when I see people posting data online that's just so clearly made up out of thin air. So I wanted to sort of clear the air, make sure everybody knows that 5% a week, it would be an inverse product or a long product that would never pass regulations. It would be so insanely leveraged. Even TVIX only decays 3.1. Could you imagine what kind of volatility ETP we would need to get a 5% weekly decay factor? It would be, obviously regulators are not going to let that pass. So don't let people who are trying to convince you to get in on the blind short vol train convince you that these things decay far faster than they actually do. Of course, that is quite self-serving. They're going to say, wow, look at this. They're going to show you charts that obviously look something like this. They're going to show you these, ad nauseum. They're going to say, well, all you have to do, of course, just use your eyes. All you have to do is just short vol and money falls from the sky, right? This is the easiest trade in the world. These products are broken. They're just, all you do is just maintain short vol positions and we're all going to be millionaires. The reality is, just like with all markets, there's both sides to it. Just like the options market, there's both buyers and sellers. There's long vol, short vol. And the reason that things are priced the way they are is because it is, at least our general understanding, a fair priced market. It is accurately pricing the likelihood of certain probabilities. So when you see something like the UVXy that decays minus 2.1% per week, it just should immediately dawn on you, wow, that thing can also spike up insanely fast. Because if it couldn't, then it wouldn't be priced that way, would it? Nobody would be on the other side of that trade. So just remember that when people sell it to you, you should short vol because these products decay so quickly. That so quickly part should be a red flag as well. That means the opposite is also true. Everything in trading, try to view it as a double-edged sword. You get that decay factor if you're smart, conservative, and you understand how to control risk, and you get blown up if you don't. That's always that double-edged sword. So that's the decay factors. Hopefully my community here, all of you smart volatility traders, that wasn't a complete surprise for you. Now you have the right data, you have the right numbers, and obviously I would always encourage people to get their own spreadsheets out, track certain data pieces that are more suitable for their investing. Like for me, for example, I don't know, I didn't have this pulled up, but I use other data pieces. I use, what is that? High volume. I wonder why there's high volume. Let me just pull up today's email here. It's this one here. View email. Sorry about that. I should have had this pulled up earlier. But I tend to use different data, much more specific to what works for me in my trading. So I've created a bunch of my own indicators, and I use a bunch of the basic indicators that you see out there as well. But this is basically how I get my trades. And then there's also a lot of other data that goes into it as well. My spreadsheets are pretty detailed. But again, I would encourage people, whatever type of trading you do, if you ever want to know something, the worst thing you can do is go on Twitter to find the answer. So don't do that. But just open up a spreadsheet, get your data, calculate it accurately, and then you have an idea of what works for your trading, right? You don't want to use my data specifically. You don't want to use other people's data. And you definitely don't want to use any data you see on Twitter. You want to have your own spreadsheet and your own data. So definitely go ahead and do that for yourselves. And in the beginning, it'll just be a very basic spreadsheet. But then 2, 3, 5 years from now, you'll be surprised how much data you actually have. I've been doing this for 15 years. So I have multiple spreadsheets that, eventually crash my computer, and then I have to split them up and have 7 instead of 4. And yeah, it just keeps going. So there you go. What I wanted to actually do, I actually prepared a little thing. If you ever want to refer back to this stream, you can actually just come to this chart right here. This is just a summary of all of what we're looking at. So VXX, here's the decay factor, 1 day, 5 trading days, 21 days, which is a month, right? There's average of 21 trading days in a month. And then here's the 1.5 times UVXy. There's that 2.1. And then the TVIX, an absolutely insane weekly decay of minus 3.1%. Obviously, that minus 5 fictional number would be somewhere, 2 times TVIX wouldn't even come close to a 5% decay factor. So there you go. You can just take a picture of this or come back to the stream in the future. You know where to find it. And there's the decay factors. All right. So that's it. That's all I really prepared for today. Every day in the streams, I'm going to do a little presentation and then open it up to questions. I'm always so nervous on camera, so I'm actually shaking. I'm worried I'm going to spill this on myself. Okay, so let me just check the stream. First of all, I'll try to spot a few questions that are exactly what I just talked about, and then we'll just do a totally open Q&A. Ask me anything you want. Scroll through. A lot of good guesses there. Some guesses that were on the high side. I only see one or two that were on the low side. So again, that goes to the unfortunate reality of social media, is that there's just going to be a lot of people saying things that are just completely inaccurate, that are pushing their own agenda. So I would strongly encourage always double checking, fact checking, do it yourself, calculate it yourself. Just make sure those numbers are accurate. Or at the very least, just think about it. 5% a week. Wow, 5% a week. That sounds like a big number. That sounds like a lot. If something decayed 5% a week, is that the reality of what we see? I mean, the UVXy or the VXX, it's only down 17% a year in the last 3 years. 17% a year. Does it make sense? 5% a week? I mean, obviously that's just, sometimes just conceptually that just doesn't make any sense that would be the number. But always check. Always get out the spreadsheet and check. All right, so Hans's question here, we'll start right here. For options, UVXy gives the same return as VXX. Choose VXX because liquidity is higher. That is absolutely true. So, in fact, I would actually argue the other way. VXX is a little bit more efficient because of the margin requirements is much less. So if you were the type of person that wanted to take on a little bit of additional risk, you would always be measured in that. I'm not encouraging it, but VXX is actually more efficient than UVXy. Even if the options market is priced very efficiently, you'll still get better use out of VXX. A, because like you said, the liquidity is much better on the VXX options market. And B, the margin is more efficient as well. So obviously, again, UVXy options, I've said this many times before, I'll say it again, it's usually just the Twitter crowd that does UVXy options. The more you know about the options market, the more you will want to default towards the VXX. UVXy gets eyeballs, gets followers on Twitter, so that's what people talk about. But no, it's not the efficient trade. You want to stick to the VXX. The only time I use UVXy is for vertical spreads. That way the vertical spread for what I call my VTS options community is actually completely separate from the VXX positions in our VTS community. But if it was up to me, I would just use VXX across the board. I wouldn't even touch the UVXy. You certainly do not ever need to use the leveraged products to accomplish what you're doing. The VXX does everything you could ever want. You can simulate any leverage factor. You get good margin benefits from it, good liquidity for a volatility ETP. That is the one, and I would say the only one that people should ever consider using. Again, never undefined risk. Never, ever. On the high side. Never undefined risk on the call side. Did you sensitivity test your findings based on the data period used? Yeah, I've done all of that. I would encourage people to do the same. So I think what you're getting at, as I interpret the question, is do I have rough data for if it's a very good decay period versus whether it's a bad decay period? So if the S&P 500 has a really good year, how much decay could we expect? And then on the other side. So yeah, I do all of that. I want to make sure that I have all the data accurate and ready to be used. So yeah, I've got that. I can put it on the list for a future live stream if you're interested in that data. Do a little 20-minute presentation giving you sort of the outliers, the best 20th percentile decay factor, the highest 80th percentile decay factor. I can do that for you. Does that make UVXy leap puts a good investment? January 2023, 10 strike put is 7 even. So obviously, full disclosure, I can't ever give out personalized investment advice. So I can't tell you whether that is a good investment. I would say the word investment with UVXy shouldn't often collide in the same sentence. So I would consider that a speculation. And you got to remember too, when you are when you're buying put options, let me pull up my spreadsheet here. When you're buying put options on the UVXy, what people often think to themselves is, well, this thing decays, right? So obviously what I want to do is I want to short this. And then they take it a step further and they say, well, okay, I trust this guy in his warnings about undefined risk. So what I'm going to do instead is I'm going to buy the put options on this thing. What you have to remember is the options market is very efficient. So you are aware that volatility ETPs do show decay over time. Again, not always. Maybe it's a terrible year and it's up next year. But you're aware of that. The thing is, so is everybody else. I mean, as I always say, everybody and their dog knows that the volatility ETPs decay. So clearly that is going to be priced into the options market. There is no actual edge. There's no expected alpha by just saying volatility ETPs decay. So I'm just going to go ahead and buy put options. And clearly when it hits 10 or 4 or whatever reverse split nightmare that it gets to, that suddenly you're going to make money. You're not, because the options market has already priced that in. So what you need to do is you need to start layering on several other edge factors, right? Knowing that they decay is a non-starter. Everybody knows they decay. Why is the UVXy starting today, going to next year? Why is it going to decay how much you think it is? What's your edge in saying that? That's what you want to focus on. I'm not saying the trade can't work. Maybe it can work. Maybe it works very well. But it's not going to work simply because we know that these decay. Everybody knows they decay. So what I do, like I showed, I have metrics that decide what the higher probability trades to be in when the market is demonstrating metrics that make it more likely for it to decay, maybe faster, maybe decaying in its lower 20th percentile of factor. Then I'm going to get into my VXX put options, which I do as well, but not because, okay, based on what I just showed you, February next year, the VXX is going to be at 997. So let's just go ahead and buy leaps. Very, very important to understand that everything you know, assume somebody else knows as well, assume the entire options market knows, and assume it's already been priced in. So you want to find actual edge, not what I would consider common knowledge. I mean, volatility ETPs decaying, common knowledge. That's not going to make any money knowing that. Sorry, I was hitting the wrong button there. This was the question. Sorry about that. All right. Han says, VX can jump a year's worth of decay in a day. Yeah, absolutely. I'm liking your comments here. Yeah, that's the thing, is everything that we do in the trading world is risk versus reward. And the risk management is not sexy. It doesn't get any eyeballs anywhere in the world. Nobody cares when people talk about risk management. Be careful. Don't sell undefined risk options. Nobody cares. Nobody's going to follow me if I start posting those things. The only reason people follow me on Twitter is because if they are high level, high information people, they might be interested in my work. But nobody follows my work because I get people excited about trading. I'm always on the other side of it. I'm always saying these are very risky things. Shorting vol is a very risky proposition. Nobody follows me for that. So yes, this is always important to keep in mind, that if you look out into the world, you're only going to see the reward side of everything. You're going to see a million people show you charts about how much money you can make shorting volatility. And they're actually going to tell you how much they make shorting volatility. They're never going to show you. You're never going to see a picture of their actual trading account, but they'll tell you. They won't talk about the risk management. So this question, this comment from Hans, always keep that in mind, that you could just be successful week after week after week, selling your calls or selling your straddles, just thinking you're a genius. And then 1 week and you're done. All of your profits gone. So yes, it's always a double-edged sword. And the more the decay factor, the more the potential spike factor. That's how things in this world are priced. It's never priced based on a lot of the reward and a little bit of the risk. There's always going to be both sides of that. So keep that in mind. Good comment. Put leaps are not affected much by giant leaps in actual price. Well, it depends. I mean, that's when you start getting into the Greeks and you want to weigh what you're doing. Are you trading in the money options more as a stock replacement strategy? If you're doing out of the money options, then you're absolutely right. It actually takes a significant move in order to even start seeing that profit going. So if you are buying leap options, again, this is not investment advice, but anytime you're buying options, personally for me, again, I can only personalize it to myself, not registered in your area to give you advice, but in the money works better. It works better as a more stock replacement method where you're basically just trying to get a higher delta factor of your option and you're trying to track the underlying price as it is decaying. One of the traps that people fall into is if you are in the habit of selling at the money or out of the money lower delta options on your volatility ETP puts, it actually takes massive moves to start seeing that money come in. So I think that's what you're getting at there. That personally, I solve the problem by keeping everything on a day-to-day basis, just reassess tomorrow, reassess the next day, and also try to keep it higher delta so you at least feel a little bit of that bang when you start getting some movement. Short VXX into the close, really? What are we looking at? 1728. I mean, it's down the last 3 days. It's down a massive amount. So I oftentimes, in one of my strategies, we buy the inverse product. That's a pretty big move there. It's recovered half of what it left, and basically the VXX as well. It's retracing, I don't know, maybe 2/3 of that. So yeah, you're gonna short it hard into the market. Hopefully it works out for you. I don't trade that way, but I don't ever tell anybody how to or not to. Here's an interesting one. Hercules Investments infamously predicted pre-election that UVXy would surpass 60. Okay, COVID, unemployment. Should volatility ever be forecasted this way? All right. Do I want to try to sidestep the landmines to talk about this? So if you know my personality, you know that I will always be respectful of fellow traders that deserve respect, right? There are a lot of people on Twitter that don't do any real work, that are just deceiving people. But I'm fully aware of what you're talking about here. Okay, so there's two things that I would say. First of all, whenever you hear in the media that certain volatility fund just made a killing, right? We hear that 50-cent trader sometimes makes just insane amounts of money. The first thing you always have to remember is you don't know what their total book looks like, right? I have had volatility trades in the past that are just off the charts profitable. But based on the overall portfolio, maybe I was overexposed to my volatility trade because I also had some other position. So I also, in the case of Hercules Investments, you can't ever be sure whether all the money they made had some offsetting factor. So if somebody like 50-cent trader comes in and they report on Bloomberg, 50-cent trader makes $4 billion or whatever it is, how do you know that that wasn't simply a hedge against a net long portfolio that just lost $4 billion because the markets crashed? Of course, in Bloomberg, they're only going to report the good part. They're going to say that this trader made this much money on their volatility trade. The vast majority of the time, people aren't stupid. They don't just buy long volatility with large percentages. Those are hedges. They're speculative, and they are offsetting something else. So I don't know Hercules Investments' whole book. I know that they did, and I've seen plenty of interviews where he was talking about his profits, and good for him. But to assume that it was just a pure profit, we could never know that. We have to know what the actual book was and how much exposure, what was the percentage that was dedicated to that trade, all of those things. So while it certainly gets eyeballs and headlines, there's almost zero information you can learn if somebody just takes a piece out of their portfolio and says, here's what it made, right? I could tell you last month, in the month of January 2021, my NASDAQ positions were up 5%. I made 5% in a month on my NASDAQ trades. Sounds pretty good, right? Until you learn that that was only one of 5 strategies that I trade, and the other 3 strategies were down. 2 of them were down 4%, and one of them was down a lot more than that. So my net basis last month was down over 4%, portfolio-wide. But I could just share the good stuff. I could make myself look like a trading genius every single month, because at no time in my life have I ever had 0 trades that are working. I could always just cherry pick something out of my portfolio and say, look at how awesome I am. My NASDAQ trades are killing it. Now this month, hey, I bought SVXY a few days ago. I'm up a ton, right? Well, I'm also in treasuries that are not doing well. So you always have to make sure that you're separating what gets eyeballs and what is actual information. And we will never know. The media will never go to Hercules or to 50 Cent and say, show me the entire book. Let's get down to brass tacks here. Because that's not sexy. That doesn't get eyeballs. So I don't know. The second part of the question, should volatility ever be forecasted this way? If it's a significant portion of a portfolio, no, absolutely not. You should never try to time volatility spikes. It is a totally futile endeavor, and you will very likely just bleed capital over time. If it's a hedge, like I said, the hedge might sometimes make a killing. But if it's only offsetting a portfolio that is bleeding capital left and right, then fortunately the hedge worked. It's very rare that a hedge and a net basis portfolio will both make money at the same time. So be careful. And the same applies to people on Twitter, right? They'll tweet out 5 trades and they'll retweet the one from 2 weeks ago that worked out well. The other 4 that lost money, of course, don't focus on those. Don't look over there, look over here. It's the old magic trick. So be very careful of that stuff. It's the easiest thing in the world to do. Just go on Twitter every day and put out 10 ideas, and then next week, retweet the one that worked best. You're a trading guru that way. You're going to make tons of money. You can open a service and charge $100 a month. And then when people join, they realize, wow, this was all just a smoke and mirror show. So there you go. Little side rant for you. I'm going to answer this with a non-answer just to highlight that I don't really know. But which ETF stock derivative would you consider to buy hold to short vol for European Union members? We do have European Union members in our community, and I know very little about those markets. I have a friend who manages capital there who's given me some ideas for certain ETF replacements. But unfortunately, there are few, if any, legitimate ways to just buy ETFs that are short vol positions or long vol ones. So what you're probably left with is VXX options. There are brokers that will allow you to trade US based options. I know US based ETFs are definitely a problem with all the MiFID II regulations and things like that. Just restricting what Europeans can buy and sell just because of those KID documents. They don't actually go through the process of making those. But you're probably looking at VXX options there. You can simulate almost anything you want just with that. So all you have to do is just find a broker that allows you to do those, and then you're pretty much good to go to short vol, long vol. You can adjust your delta factors and make it a 1.5 or a 0.6, whatever leverage you want to do. Remember, VXX options can simulate literally any exposure that you want on any time frame you want. You just have to know how to trade those options to your advantage. You can simulate UVXy, you can simulate the old TVIX. If you want to get something that decays 5% a week and then spikes 5,000% when it goes against you, you can do that too. Obviously, I wouldn't recommend it. During the last stream, you mentioned that SVXY could actually blow up in a period of high volatility. Yeah, Volmageddon 2. Follow up. I wonder how you can be so sure when we have gone through a complete economy shutdown worldwide and the SVXY survived. Can you comment? Yeah, I can comment. To fill people in, I was talking about the October 1987 crash where the old VIX calculation that we can actually drag back to 1986. The old VIX is called the VXO. It was using the S&P 100 options. And the old VIX went from $32, not dollars, percent, but 32 on the Friday. And then Black Monday, it reached an intraday high of 172%. So it was basically up 372% in a single trading day. And if an event like that were to happen when the volatility market existed, then it would have terminated every single one of the inverse volatility ETPs that we have, including a minus 0.5 times SVXY. And then I also mentioned, just for fun, that 2 days later, it definitely would have terminated TVIX on the long side, because volatility crush can also terminate volatility ETPs. and TVIX would have been delisted, and UVXy didn't get there quite, but it was dangerously close as well. So the reason that I say that SVXY could crash is because personality-wise, investing philosophy-wise, I will always tell the truth about risk management. And doing this, is never a good idea. You have to know your risk. You have to understand what's the worst case scenario. So for me personally, worst case scenario, I could lose the SVXY. That could happen. Now, I have metrics to get me into safety before most of the trouble happens. But let's be honest, volatility spikes, while they typically happen when volatility is already elevated, there's nothing saying it couldn't technically happen when everything is calm. So while you're right in saying that we have experienced some incredibly volatile markets, and it's not realistic to expect the SVXY to terminate, I don't see how it's harmful to just assume in my portfolio right now that could happen tomorrow. How should I position my portfolio knowing that the stocks could crash 20% and the SVXY could lose all of its value? How would I account for that? Well, I'm actually going to put this on a list of future topics to get to, because I could do bullet points of, once you put that thought in your head that tomorrow could be the worst day of my life, then you can actually take certain steps for risk management. And there's actually plenty of things you can do to mitigate the risk. But the first thing you have to do is acknowledge that the risk is there. I don't think it does any good to say, well, technically SVXY did survive Volpocalypse and it survived COVID. So yeah, let's just assume that it can't happen. No, it did happen. It happened in the past. So yeah, that's the right one. It's already happened. So just assume that it could and probably will on a long enough time horizon happen again. But I'll put that on the list of things to really unpack in detail for a future stream. Very important subject there. Oh, Benoit. I hope I'm saying that right. I think so. Looks like a French name, if I'm guessing correctly. I'm from Western Canada, so I speak very little French, even though I took French for 9 years. But thank you. Thank you for subscribing. I hope you find value in what I do and you can make a lot of money. Slowly, safely. That's what we're about. We're not about high risk taking. Yeah. That's that. I believe that's that put option question. I don't get into these too much, Cam. What if we see an inflationary or, stagflation, or what happens if the dollar does this, or all of these things? I would put those into the basket of macro events that, sorry about that. I live in an area right now where there's a lot of sirens. Every stream we get this. Macro events like that, if you are the type of investor that needs to buy and hold for some reason, like if you're actually setting up your portfolio that you're not anticipating selling anything, then this is absolutely relevant to what you are doing. For me personally, I trade everything tactically on 1 day timeframes. So I get up today, I check all the metrics this morning, I make all my trades for 1 day, take my trades heading into tomorrow based on the highest probability of success, and then tomorrow I do the exact same thing. Calculate it all again, make sure I'm in the right positions. If everything's good, I just maintain. If I need to make changes, I do. And I go 1 day. So even though sometimes I hold the same position for months on end, if the market's really cooperative and we get a trend, I still consider my trading day to day. So something like inflation, something like the dollar, something like Fed policy, all these things, they don't affect me because I'll just wait for the day that it actually happens and then I'll adjust accordingly. Long way of saying I'm not a macro investor. I'm much more of a in the moment tactical volatility investor. So you have to take things into consideration based on your own personal time frame. If you are a long-term investor, then yeah, dig in, study up on that stuff. I also find it just incredibly difficult / impossible to get accurate, not only data, but just accurate predictions about anything macro. Like, we always, as investors, have recency bias, and we always think that right now that things are bad and we know where it's going. Well, the debt situation is going to do this and that, and the dollar is going to do this, and this is going to cause the market to do that. I mean, if you were to write down every one of them, every day you have an idea, you write it down, you'd probably find that 5 years from now, half of them were right and half of them were completely wrong. So hopefully you're better than me at it, but I don't find any accurate predictions about long-term events. I'm wrong just as often as I'm right. So I can't trade on something where it's flipping a coin. How do you use the decay analysis to choose the strike price and the time, the entry in the vol trend strategy? That's a super complicated question. It probably surprise you how much goes into that strategy, because at the end of the day, it's just spitting out naked naked VXX put options. Or you could do spreads as well. You could do verticals and make sure it's defined. Yeah, I'll save that one. Of course, I'm going to introduce it to the community over time, and I'm going to write several blog articles. I can't do it in a short time span, but one part of that, the decay analysis, not really taken into consideration. I don't want to give people the impression that because today I presented the decay numbers, that somehow I use that. Like today, the VXX is at 1730, so I'm going to say, well, next week, because we just saw that the VXX decays 1.1% a week, that next week I'm just going to set my strike there and not expect it to go. There's many, many things that we have to factor in, because it could go down 10% next week and we could be in a lot of trouble. It could go up next week and that trade would make a tiny portion of profit and then it's out and it can't make more. So obviously it's much, much more detailed than that. The decay is just having fundamental data underlying how much on average these things decay. Good thing to know for sure. Why not trade VIX futures directly? Appreciate your thoughts and pros and cons. Thanks. Essentially just being pragmatic. Trading futures, while I could do it personally in my private portfolio, there's really no reason to. It doesn't accomplish anything. The underlying volatility ETPs already do that. They already have a methodology that works. It works just fine. They manage it very well. It stays almost exactly on its intraday indicative value most of the time, vast majority of the time. So I don't think I need to get into that. I trade ETPs, ETFs, and options, basically. I don't trade any futures. I don't trade VIX futures. I don't trade commodity futures. Just don't really see the point. And then, of course, as a little side benefit to that, because I do have a community that follows my trades, logistically, and different people in different account structures, trading futures is a nightmare. So it just wouldn't work. But even if I was just trading my own portfolio, no reason why I can't just use the products that are out there. This is something that people often misinterpret, that somehow because products like this, that they look like this, that they decay like this, a lot of people have the thought in their head that, well, that means that this is broken. That means it's manipulated. It's a broken, fraudulent product that, of course, you want to trade the futures directly because clearly this is broken. When in actual fact, those products function almost exactly as they are intended. They're very good at managing them. And then, of course, they have authorized participants that also help them manage with share creation and keeping everything in line. So I don't see any reason to trade the futures directly, unless it was just something that you wanted to do. Nothing wrong with it. It's just an additional layer of why bother. Here we go. How long have we been going? So can I take just a 10-second detour here and ask everybody to follow me on Twitter? The reason you want to do this, not for, like I said, people don't follow me on Twitter for excitement, but they follow for information. But also because I will always give a heads up to people who follow me on Twitter when the next live stream will be. So if you want to do that, go ahead and follow me. And while I'm at it, let me just be super selfish here. Give the video a like for me. The YouTube algorithm requires me to ask you that. It's basically the law. If you don't ask in a YouTube video to smash the like button, you're not a YouTuber. So for whatever reason, that like button gets more of the algorithm's attention. So just do me that favor. If you're just sitting here, just hit that like button and we will continue. So where was that question? Yeah, after the VIX futures. So what's a better hedge against black swan events, VXX or UVXy? Well, as we talked about, they're the same. The only difference would be the amount of your portfolio that you would allocate to it. If you were using UVXy, you would need a little bit less because it has the leverage factor. It has a little bit more convexity. If you're using VXX, then you'd probably have to dedicate a slightly larger percentage of your portfolio to it. But there's no better or worse. You have to start with the baseline assumption that, the options market is very efficient and there's no way to really game it. The premiums that you're paying, they are actually based on something. So, and the something, again, assume that those are sophisticated investors making those trades. Don't assume that it's you versus some person who doesn't even know that they decay. Assume that it's a person as smart as you on the other side. Of course, it's market makers and dealers. It's not a dude on the other side. But I mean, practically speaking, there's someone on the other side of your trade. Hans, interesting question. It's macro again, though, so doesn't matter for my trading. This is one of those flip a coin. I mean, I'll be wrong just as often as I'm right. Hyperinflation with the VIX go positive correlation to the S&P. I don't see any reason why those would be connected. The VIX index is just based on S&P 500 options activity. So would a hyperinflationary environment cause people to make a relative change in the options they're trading? Surely you could say, well, there's probably more incentive to do calls or whatever you're getting at, but it has to be a relative change, right? It's just not I don't know if that would fundamentally change the way people manage their portfolios. They will still need the puts for the reason they need them today, and they'll need the calls for the reason they need them today. I don't think that dynamic would change. The actual price of the S&P might change, but I'm not sure that the options activity would. If we're making the assumption that people are managing their portfolio correctly, then I would say no. If people are misinterpreting the situation, then yeah, it could do that, possibly. Again, flip a coin. I mean, that's a long-term macro question that I wouldn't put a single dollar on my prediction there. Yeah, that's what options can be really good for is stock replacement, simulating the underlying position that you're looking for. And if you wanted to change the leverage factor somehow, or you wanted to reduce your margin requirement somehow, then options can be good for that. So I have nothing wrong with people saying, okay, a year from now, I'm going to make a bet on where the VXX is. But I would just say that you want to make sure that it's less speculation and more stock replacement, and then kind of lean towards in the money a little bit if you can. Here's a specific VTS question, but I will always answer these, of course. Have you ever tried the VXX with the wheel strategy? So the wheel strategy, for anybody who doesn't know, it's essentially where you sell a cash-secured put option on something, say Apple, for example. You set aside the amount that it requires to hold, say, 100 shares of Apple, which would be a lot of money, but bad example. Let's use a $20 stock. You sell the cash secured put. If you don't get assigned, you just get to keep that premium. If you do get assigned the shares, then now you keep the premium, but you're left with the shares. And then you turn around and you sell covered calls until you actually lose those shares. So that's the general structure of the wheel trade. Do I ever do it with VXX? Yes, absolutely. Of course, it's an inverse. So now volatility is decaying downward. If you're selling cash secured puts on the VXX, of course, you do have to be careful when you do that. If you would have initiated a position on Monday, you'd find yourself 15% in the money right now. If you initiate it today, then, you'd probably be better off. But remember, the wheel on a VXX is going to be sort of an inverse wheel as it happens to a regular stock. But yeah, absolutely. The strategy works the exact same way. And I'm sure you're asking because you already know. I do this all the time in my own portfolio. It's one of my most heavily traded strategies. So yes, I do that regularly. Every single month for the last 8.5 years, I've been doing wheel trades on VXX. Several per month. I probably haven't gone a month without at least 3 or 4. Yeah, it's a big part of my own portfolio. No, adding anything to do with currency, it's just adding another factor to my investing. That is, while again, I can't say that it wouldn't add benefit and make money. And if somebody was good at it and they actually understood the dynamics of currency markets, sure, they could do fantastic with it. For me, it would just be adding a layer of complication that's not necessary. So I try to keep things very simple if possible. If you look at my work, it's not simple at all. I mean, people get confused following it, but I always go towards simplicity anytime I can. September 2020 got crushed short vol and leveraged bond hedge lost big too. Well, short vol had a rough couple of days there. Honestly, I can't remember what happened to other markets. What if you were short XIV when it dropped 96% before termination? Well, if you were short XIV during regular market hours, you were down about 35%. And then if you held on to the position an extra day, of course, as we know that the 15 minutes in the aftermarket rebalancing caused it to go from whatever it was, 35, if memory serves. I don't have that data. Up to the 96.1% that it eventually ended up losing. So that's what you would have lost. You would have lost, if you were short XIV. Short XIV. What if you were short XIV? Well, I mean, it's just on a one-day inverse. So, sorry, I got confused there. If you were long the XIV, you were obviously in trouble. And if you were short, you did very well. So, I don't know why anybody would have been short XIV, though. But yeah, that was one of those days where there was a distinct difference between the intraday and the aftermarket rebalancing. It's only really happened that badly that one time. So, but again, I would default to safety and try as best you can to use the VXX, the options. Try to be as safe as possible. Shorting something, shorting an ETF, even though in that case you looked like you were saying short XIV, shorting anything has unlimited risk, of course. So if you get something truly terrible, some type of flash crash or cyber attack, I would never be caught short with undefined risk. That's a bad idea. Sorry, my screen is covering this. Can you give an example of your option trade in the last year from March to May? I assume you mean during the COVID crash. So I moved my entire portfolio to cash at the end of February, and I didn't take any trades until the middle of April. So I just skipped the whole COVID crash. I had 0% drawdown. I just went to cash. If I was to be managing that situation, I would have been long vol in my option trades, and I would have been in bonds, mostly bonds, gold, and utilities in my broad portfolio. So, but I just, for many reasons I've gone into with my own community, we just moved the whole portfolio to cash, and we were in cash for over a month. So COVID kind of came and went as portfolio wise with no impact at all. We just, we skipped the whole thing. Bryce, are you showing off? I said I took 9 years of French, so you're trying to make me feel bad that I can only say about 3 words. As Canadians, we have to take French. So I took it for, 9 years, grade 2 to grade 10. I don't speak any. Yeah, this is very true. I mean, all this talk about termination, I don't think that talk is as useful as just drawdown talk. I think drawdown is very relevant to every single investor out there. Talk of termination, I mean, obviously it's a risk out there. There could be cyber attacks, especially in this market. I mean, if there's people out there thinking that what happened in 87 couldn't happen again just because of circuit breakers, you know, the S&P goes to 7, it shuts down, goes to 13, it shuts down, and then if it goes to 20, it's done for the day. That's not going to protect anything. If we get a legitimate thing, all that's going to happen is it's going to halt for 15 minutes, and then within 1 second of reopening, it's going to go to the next circuit breaker, and normal people can't make trades. Only the computers can make trades. So for people to think that one-day termination is not an issue. It certainly is an issue. But I think the bigger issue, which you're getting at here, is more to do with, I think talk of drawdown and risk management is far more relevant. So 2 to 3 day crashes, 5-day crashes. What you do in those 5 days can make or break your trading career as well. Much more so than a 1-day shock. If there is some type of crazy event, well, I wish everybody luck. I wish myself luck. I hope I'm not holding the wrong trades when that cyber attack happens. What can we do? I hope I'm diversified and my position sizing is on point. I hope. I think I will. I'm very conscious of risk, but I'm much more concerned about controlling longer term drawdowns like weeks and months. That's what I focus on. Are there any catalysts you think that might cause the market to drop in the next few months? Again, I'm even hesitant to answer these because I don't take it into consideration even a little bit for what I do in my investing. I am literally 1-day data driven. And again, doesn't mean I can't hold the same position for 2 months if it cooperates every single day, but I will reassess. So do I care what happens 2 months from now? Not really. Not at all. I'll tackle it when it's a day away. Hopefully I am positioned for the next day in the best position possible. Any catalysts you want me to guess at? What's on the horizon? Well, we've got a fairly botched COVID vaccine rollout. We've got an economy that, while everybody's trying their best to give the most positive news possible, we've got an economy that is absolutely devastated. And all you have to do to know that is just go outside and open your eyes. I mean, the fact that there were actually people bragging about GDP numbers this quarter is embarrassing. I mean, go outside and open your eyes. I don't care what the official GDP numbers say. We have an economy that is absolutely destroyed. We have an employment market that is, again, regardless of the official government numbers, is ask 10 people you know, 5 of them are going to be saying that their life is seriously hindered by all of this. So if that's not a catalyst, I don't know what is. The fact that debt is rising and we're not getting anything out of that money we're paying, that's a problem. I could think of tons of catalysts. Whether I'm going to take that into account, no, not at all. I'm just going to take the markets one day at a time, data only. I know who this is, of course. Not sure why you're not sleeping. It's Taiwan. You should be in bed now. But thanks for checking out the stream. It's a little bit embarrassing when family is on the stream, but thanks for the thumbs up. Winston, SVXY survives March 21st, 2020 volatility spike when VIX reached 84%. So it is pretty safe. Backwardation reached 20% for a while then. It really, again, it depends on, I don't want to get too much into the weeds on termination because that's not a major concern of mine. Mine is more what happens in a 3-day time span. But yeah, anybody who's saying markets have done some crazy things in the last 25 years and volatility ETPs would have survived. That's a true statement, right? All of the volatility ETPs would easily have survived the financial crisis. There would have been at no point were any of them in any trouble if they were existing back then. Volatility was very orderly in the financial crisis. It did reach 82 on the VIX, but it reached it in a very orderly manner. So yeah, they all survived. The question you need to ask yourself is, who's to say the next crash will be like the previous 5, right? I mean, who's to say? I don't say. I just make sure that my portfolio is always ready. Again, the one rule of thumb that you should probably try to keep in mind, allocate your portfolio in such a way that if tomorrow is the worst day you could possibly imagine, you'll still be in the game the next day. It doesn't mean that you're not going to just get kicked in the gut hard, right? If tomorrow's the worst day imaginable, all of us are going to be in a world of pain. The question is, are you in pain or are you dead? Are you out? You're out of the game, you're blown up. That's the question you need to always ask yourself. If Black Monday, October 1987 happened tomorrow, Black Thursday 2021, if that happened, I would be miserable. I would take a major hit to my portfolio, but I would completely survive. I would be just fine. I mean, the money, again, this is getting into what I'm planning for a next live stream, but constantly rebalancing your portfolio along the way means that all the profits I've made in the last 15 years have been constantly balancing out. And if I lose my entire volatility fund, that's 20% of my portfolio. I still banked realized gains for 15 years. So I know it's going to be a miserable one-day hit, but the longer you do this and the longer you constantly rebalance your portfolios, it definitely pays off to have a volatility allocation. You just need to know what you're doing. You have to do it correctly, because there are ways that you can have 15 good years and then blow up and lose it all. But there are also ways that you can have 15 good years and then get hit with Black Monday and still be just fine. So it really is, the devil is in the details there. I will be a very miserable person if that happens. But financially, I'm not in that much trouble if that happens. It would suck, and it might take me a while to get out of it. But I have planned my portfolio to be able to withstand the biggest crash ever tomorrow. It's just that's the way that I trade. I'm not suggesting that it would be fun, though. That would be a massive chunk of all of our net worths gone. Andrew asks, when's the next vol trend? I was looking at it today. I mean, just the way that the markets are trading. You could maybe expect one soon. I could see that soon. VXX has crushed quite a bit. You want to be careful selling anything into when there's extreme vol crush potentially built in there. If we want to get an actual metric here, anytime you've got the volatility risk, like the simple VRP here, the volatility risk premium, it's still very high. This is signaling that there could be a lot of pent-up volatility crush in the market, right? A lot of these indicators are showing that we could see one of two things happen. The markets could absolutely fall off a cliff based on all of those metrics. I mean, it would not surprise anybody if by next week the stock market was down 15% from where it is today. I don't think anybody would turn around and say, well, what could have possibly caused that? There's an unlimited number of catalysts that could spark that. But what those metrics are also showing is that there was pent-up potential there for significant volatility crush. And that's what we're seeing in the last few days. If you've got a very high risk premium there and you get a stable market, you could end up seeing what we've seen in the last 3 days where they go down. You can't really short vol into that, though, because, again, the opposite is always way worse than the benefit to it. So you kind of just have to watch it happen, and hopefully you catch a trend next time. But to answer the question, we might get one soon. Here's one. Don't know how to say that name correctly, so I won't even try. As a general rule, would deep in the money VXX put leaps work better or monthly 30 days out? Again, the options market's efficient, so this has all been priced in. But anytime that you're shortening the duration of your trades, your option trades, what you're essentially, in a quasi way, you're adding leverage, because the 1 year premium will always be less than 12 individual months added together. So you can make more money if you're doing monthly cycles. But then making more money, like I said, adds the double-edged sword of you can lose more money too. So people who are trading longer term, that would be considered a safer trade. Anytime you extend the duration of your option trades, longer expiration cycles are going to be safer. They move slower. So if you do get hit with an adverse market that you didn't see coming, your trade's going to be much better insulated against that. If you go down to the monthly cycle, well, now you can make more money because you can get 12 of them in a 1 year time span. But if you get a move, your delta and your gamma is going to be higher, and you could get hit harder from that. Take it down to a week, same concept, now on steroids. Your weekly trades, while they can make a lot of money, now you can lose way more than you can make. And so whether as a general rule, what's better depends what you're trying to achieve. If you want to be a safe trader who's always surviving and profiting long term, you always want to stretch out your duration. It's really one of the sort of general risk management principles. is duration is beneficial for you, because we always get hit with things we can't see coming. And so, spacing it out a little longer, while it doesn't look quite as attractive on the profit end, it's definitely a little bit more insulated against sudden drawdowns. Volatility variance swap. Well, I'm not much of a technical person. There's plenty of people you would probably prefer to ask this question to. I think why you're asking this is, let me do screen share. You've got some of these volatility ETPs that, if it's an ETN, like let's pull up UVXy. You can see that sometimes they use swaps, essentially. So where's the daily holdings? There we go. What you'll see sometimes is some of those, their holdings are not always the front 2 month futures, right? You can see here there's some swaps, and they can change in value. Essentially, it is a way to peg a future bet against a counterparty. I don't really know the best way to explain it, but it's basically more of like a two-sided trade where you're positioning against a specific outlook that you have, and then you're pegging that to the bet. And you've got that variance swap where profit and loss is, I guess you'd say it's more tangible, it's more, quantifiable. And so sometimes you'll see people doing, variance swaps and whatnot, but it's not anything that us retail people would ever have to worry about. This is institutional stuff, which I am far from an expert. I've never worked in the financial industry. I certainly don't know very much about compliance and things like that. So, technical stuff like that, I'm mostly the investor, not on the regulation technical side. Robert, does VTS have probability and expectation analysis software available? No. All VTS is, not all it is, it's what I do, but VTS is just me sharing my portfolio. That's it. There's nothing outside my own portfolio that is ever shared. And while I do, a small portion of additional trading myself, the vast majority of what everybody sees is just what I do. So I haven't really taken my work into the software stuff. All of those metrics that I have no programming ability at all. There have been times when I've considered getting into that. Maybe I could do some type of live dashboard or something, but I don't think that's helpful. I think you gotta sort of stay in your lane and do what you do. And for me, VTS is my portfolio. So I don't think that there would be any downloads for people, any live dashboards. I don't anticipate doing any of that. Okay, tax consideration for futures, sure. Yep, there's always, and for different people in different account types, taxes are always an issue. For me personally, and again, VTS is only what I do. It's not what, I couldn't possibly speak for people in other countries. But I trade everything in non-tax sheltered accounts, and I just pay short-term capital gains. I like the ability to trade whatever I want, whenever I want. So those are the only types of accounts that I personally open. If people are in the habit of trying to make everything tax efficient, that's fine. I wouldn't tell you otherwise. You can do that. I will say that there is certainly reasons to believe that tax efficient portfolios tend to underperform. And that's when you factor in the tax efficiencies. I think there's reason to believe that's probably a thing, especially when you start deviating from the norm and you get into volatility trading and options trading. Then you're getting into a situation where it might actually be beneficial to just ignore the tax and account structure thing and just do what's best in the moment. But certainly if you're just a more standard investor, then looking for things like tax efficiency and trading futures, and yeah, you could consider all of that. It's interesting. How often does market crash with VIX? Well, you'd have to define the terms there. What is a market crash? If you're talking about if Can the market go down 20% and have the VIX go down? No. I mean, anything is possible, but no, that doesn't happen. But can the market go down significantly on a short term, like down a few percent, and have it still correlated where the VIX is also going down? Or the inverse, to same question on the other side, can they go the same way upward? Yeah, sure. But once you get into a range of certain magnitudes, then you are talking about an inverse correlation there, where if the markets crash, the VIX goes up. For new subscribers, how would you suggest to get started? Match all the positions as of the day of start, or only start putting money into that are changing per email? You nailed both of them there. So if you go on the website, I have a Q&A section on the website, and it has a little search function. So what did I call this one? Just joined. Just signed up. Do I take, here we go. You've got two options. You could execute your trades. Wait, is that the, oh no, that's not the one. Let me just try to wing this, but you'll get a better answer if you go through the Q&A section and actually get my full write-up. But essentially, it doesn't matter. I mean, if you're talking about a long-term, multi-year time horizon, then what you do doesn't matter. So you can either join and you can just jump into all the trades the very same day, because like I said, everything I do is on a one-day basis. So there's no advantage or disadvantage by joining the trades. We are still looking on one-day time horizons. So if a trade is sent out, if it's buy the SVXY today, and I'm in it from a few days ago, and you're just joining it, my cost basis is going to be better, but that doesn't matter. That's just an illusion. If it goes up or down a certain percent tomorrow, we both feel the exact same impact. So you can join right away, or what you can do is just wait for the next fresh change of position, and you could, if you're more comfortable with that, you could do that. But totally up to you. New members can find out what suits them best. Maybe you want to follow along for a couple of weeks and not take any trades. There's any number of things, but all I can say is the trades that are sent out every day in my email are the ones that I'm personally in. So if you want to join me, that's essentially what VTS is. But never do anything you're not comfortable with, of course. So make sure you're understanding that what you're doing. I don't just say that as soon as you sign up, you have to start allocating your capital. Of course not. Okay. Can you calculate the expected VXX of tomorrow based on M1, M2? And is the adjustment in the VXX fund done after market close or when? Toby. If that's the Toby who I know is a member, then thanks for checking out the stream. No, you can't. You can calculate, if you're saying expected, sure. We can calculate within a range of probability where we expect it to be. That's essentially what quant style investing is doing. We are trying to position ourselves to be the most likely situation, and everything works within expectations of standard deviation. So if the VIX futures are at 5% today, the general rule of thumb would be, and this applies to all investing, the markets tomorrow will more than likely look like today. All right, so tomorrow, if we're at 5% now, it's most likely that we will be at 5% tomorrow, or some tiny sliver of threshold of variance there. That doesn't mean that it couldn't crash completely and go to -5 or 10 in backwardation, but most often tomorrow will look like today within a small standard deviation. So we can never make any predictions. The VIX futures are not forward-looking in the sense that we're trying to predict anything. It's just forward-looking in the sense that that's how markets tend to move. So all of my work is based on looking at all the data right now and, sort of on balance of probabilities, what will most likely happen tomorrow. That's what I do. And that can be achieved. Obviously, with my track record, I can say with absolute confidence, yes, we can predict markets. While we can't exactly predict them, we can certainly position ourselves statistically that if you run the same simulation 1,000 times over, you'll get more wins than losses. And in the end, that will add up to nice profit. So I can predict the markets. I just can't predict them tomorrow. If you give me 1,000 tries, I can predict it more than 500 successfully. That's, I guess, the point. So, no, we don't know where they're going tomorrow, but I can make a very good guess of where they were likely to land. Another vol trend question. If it's a depreciating asset and you get assigned, you just hold. If it can't, this will all be explained. I promise you. My workload is pretty insane. I don't know if you guys are aware of that. Just emails alone, at least 5 hours a day. And then I've got my normal work, and I've got, occasionally I like to do a nice stream for people or do a video. This will all be unpacked. The simple answer is, how do I even give a simple answer? When you're holding when you're holding a put option on the VXX that is out of the money, the best situation, let's say, where's the market right now? Let's give an actual example. VXX is at 1732. If I sold a 1650 call right now, or sorry, a 1650 put on the VXX right now, I lose money as the VXX goes down. So intuitively, most people would look at that and say, this is a long vol strategy. You want volatility to go up so you can keep your premium and you can make your money. I consider my vol trend a short vol strategy because the ideal situation for me is for that VXX to expire at 1651. Right? That's the perfect expiry, 1651. So I start at 1733. I want it to go to 1651. I make 100% of my profit then, and then my next trade has even higher probability of success. And so I want that one. I will sell out of the money, and I want that one to keep going down and to expire right on the money. If you happen to get your gauge incorrect and you get assigned the shares, then you sell covered calls. And this is the part that I will unpack in a much more detailed article. But there's nothing saying you have to sell covered calls at the expiration that you got. If I get assigned at 1650, I don't have to sell a 1650 covered call. I could sell a 1450 covered call, which means I'm going to lose $2 when I lose that contract. But the covered call might pay me $2.20. And then I actually made 20 cents on this trade. Even though the shares lost $2, the covered call made $2.20 and I profited. And now the VXX can go all the way to 14 and I don't get hurt by it. So intuitively, seems like a long vol strategy, and it seems like something that you'd get into a lot of trouble if the VXX continued to go down. But that's not actually how it plays out, practically speaking. So clearly I need to do a much better job unpacking this and explaining it all, which will. Again, Hans with the good rules of thumb and words of wisdom today. If you're basing your portfolio safety on the absence of a termination event, that's asking for trouble. Yeah, I don't think it's mutually exclusive. I think that traders can both protect their risk against crazy extreme events and still make money and still profit. You don't have to make this hardline decision where, okay, well, I have to manage my portfolio and make as much money as I can, and if the worst thing happens, boom, I'm dead. You don't actually have to be so extreme. You can still be a very safe investor and still make a very good rate of return. And it does take effort and work. Obviously, the easy thing to do to make more money is to take on more risk. That's what rookie traders do. I want to make 30% a year. I'm just going to take on insane risk and, roll the dice, cross my fingers, and hope for the best. You don't actually have to do that. You can definitely protect against the worst while still participating in at least a good percentage of the best. So that's another great comment. Tom says, yeah, this is interesting too. GDP not affected until all the extra money gets into circulation. Then you see the inflation. That's kind of what we're expecting to happen, is that everybody kind of sees inflation on the horizon. When it will start materializing, nobody really knows, because we've been saying the same thing for a while. But yeah, the GDP numbers and everything, one of the reasons I don't go into the weeds on it is because there's so many intercorrelations that you really, every level you add to your analysis, it it gets a fuzzier picture. And then you add inflation, then you add employment, and then you add the Fed action, and then you add the government decisions, and then you add, all these things, and you end up with something that's just, the water is so muddy that you can't even make accurate predictions. So I try to dumb everything down to the least common denominator and just make my profit and protect my loss. That's, if inflation happens, boy, I don't want to see it, but I'll tackle that when it comes. There we go. Got my back on this one. 90 watching, 55 likes. I don't like that ratio. So yeah, you're right. There should be more likes than views, right? Because some people came, watched it for a few minutes and left. But of course, we hate asking for likes. It's just the dumbest thing in the world. I wish I could just come on and talk. And unfortunately, the YouTube algorithm just turns us into beggars about the like button. Out of all the metrics, which one do you rely on most? I mean, I have more metrics than this. I don't like to bombard the community with just tons of information. So if I wanted to give you a short list of where you would want to start, all of them are useful. I'll never share anything that's not useful. So I don't do anything to impress anybody. This is just my own portfolio. None of this is fluff. None of it is like, hey, this would be cool. This would get some eyeballs. I don't do any of that. This is literally my portfolio, and I'm sharing it. So everything you see is something that I deem important for different reasons. But if you really wanted to narrow it down, obviously the volatility barometer is number one, because this is the most comprehensive volatility index that there is anywhere. I mean, I've created my own volatility index that's far better than anything out there. So you definitely want to really understand the volatility barometer. And for people wondering who don't know, there's a video explaining the whole thing. You can check that out. But you want to do the cash VIX oscillator. VXX crush level, adjusted, VRP. That's a good start. Just do these 5. And that's a pretty good start. But again, I don't share anything that's not useful. Like VIX minus volley, it gives a lot of clues there. The crossovers of all the cash VIX stuff, like these things here, super useful stuff. Again, the most commonly quoted things, of course, the VIX and the VVIX, probably of all the volatility indicators, indexes, ETFs out there, VIX and VVIX are probably the most common ones. And ironically, they're the least useful. So all of my work that is based on taking what we have available and overlaying my own knowledge base on it, I think they're useful. That's why I share them. So if you understand what I mean by the cash VIX oscillator, and I have an full article explaining it, showing how to calculate things, not the exact indicator, it's proprietary, but I'd start with those. I'd start with the actual, the specialty indicators. So the volatility ETPs now have marked their, essentially it's shifted to a 4 p.m. It might make things a little bit easier, to understand for people. Yes, it has changed since the crash. Now settlements are at 4 p.m. So that's just something to be aware of. It won't affect anything really anybody does. It's just if you like that kind of information, yeah, the settlement has changed a little. But how do you prove that your more than 50 win rate, even after 1,000 tries, happened not by accident? You can't prove anything like that. You can just look at the data. Like everything I do is data related. So this is going to seem incredibly self-serving. So please don't think I'm trying to promote or pump anything. But if you go on the website, if you looked at this, these are, live trades that have gone out to the community. I don't post any, this is not a back test. This is all the compilation of live trades that have gone out. Where's my total portfolio solution? Does any of this look like luck to you? I mean, if it does, then that's perfectly fine. Everybody is entitled to their opinion. If this looks like it's just been, over 9 years of just straight luck, then yeah, I don't suppose I could prove anything to anybody. But all we can really do is be data driven. Obviously, you want to have correct data. You want to understand how to use the data, and then you want to apply it to trades that make money in the long run, right? We all have losing trades. We have periods of ups and downs. What you're looking for is a demonstrable way to prove that your method works. Aside from a track record, what could prove that? I mean, I'll do my best to, I don't show my long-term portfolio. As everybody knows, I don't share income. I'm not actually screen sharing, am I? I don't share my Interactive Brokers portfolio at all, but I don't mind showing people performance of this account. This is just the live stream money so that I can sort of have something to show people. But yeah, I don't mind. You can see I funded this account recently. I'll show stuff. I mean, if what you're looking for is sort of information on whether a person knows what they're doing, that's kind of what this live stream account is for. So I'll be able to prove some of the things that I'm saying. But I guess that's what your question's asking. How will I be able to prove that it's because I got better than 500 average because of the metrics or because of luck? The longer you do something, the more successful you are on the longer term time horizon, the more likely it is attributed to skill rather than luck. But of course, there's what's called self-attribution bias, which is a cognitive bias that a lot of investors have, where they attribute success to their own doing and failures to some external source. That's what self-attribution bias is. So sure, there's a little bit of that baked in, but if you do it long enough, clearly the answer is that person knows what they're doing and that person doesn't. It's very easy to see. So the answer is track record. I have a very good track record. Again, I'm not saying this to promote, or I don't do that kind of stuff. Nothing I do is marketing. Just trying to answer the question. But yeah, I don't think you could ever look at my work and objectively say that it is not working. I think it's quite clearly working. Not always. I mean, I have bad years, but I don't think you could genuinely say that, what you see is weakness or something that's just the function of luck. Nobody's that lucky. Not claiming the greatest in the world or anything, but yeah, nobody's that lucky. My track record's very, very solid. To come back on your wheel trades, what's the average number of days till expiry? Average number of days. I do the weekly contracts, so sometimes I'll do it the week before, like maybe tomorrow, for example. I'm not saying that this is coming, but maybe tomorrow I might look for next week's 16 strike on VXX or the 1650. If I'm allocated enough to short vol and long equities, then maybe you could get aggressive and do the 1650. Or maybe I would do a shorter term, just 2 days in advance, and it expires on Friday, maybe that. So I would say 3 to 8 would be typical, somewhere in that range. We only have 2 questions left, so we're basically going to call it here soon. Hour and 43. I'm so terrible at cutting these short. I should, though, because if I can reduce these to about an hour or maybe an hour and 20 minutes, then I could just do more of them and everybody could, we could just do this on a weekly basis. So apologies it's so long. How many people? 85 people still here. To all 85 of you, I'm sorry. I'm very bad at time management. And as you notice, I can talk a lot. So as long as I've got coffee, I could stay here all day. I don't like answering specific subscriber questions because I just don't promote, market. That's not what I'm about. But let me see what this says. Do I share some historical data, barometer reading, last X days? I don't share much of the past work. The reason isn't because I don't want to help you. Believe it or not, I do have a lot of copycats out there who look at my work, who subscribe to my signals. And I've actually had services that literally pay me money, subscribe to me, And then 10 minutes after I send my email, they send the same one to their community. Copied and pasted. Same charts, same blog, same trade signals. I've had services out there that are charging people money that are actual copycats of what I'm doing, just delayed by 15 minutes. And, you know, I've shamed a few of them publicly, and they've taken their websites down. But there's just a lot of what I do is what I do. It's proprietary to me. So this is always one of the things that I feel horrible about, that I'm not allowed to share. Not allowed. I'm not able to share the information that I want to because of a few bad actors, right? If everybody was using the information honestly and they weren't trying to remarket what I do and repackage it and dump it off to someone else, then I would just be able to open it up and just share to the world. I have to walk a little bit of a line there because of how many people follow my work and use it to send to their own clients, like financial advisors and hedge funds. And, you know, I know who these people are, and I know that they have clienteles, and I know it's fine with me, but I do have to scrutinize a little bit what I share. So unfortunately, for the most part, that would be a no. If you email me directly, I don't know, maybe, but no. Margin's always better. You don't have to use it, but margin account's better. The problem is cash sheltered accounts are not margin accounts. So I'm not telling you to not use an IRA if you're an American, or RSP if you're Canadian. I'm just saying that if you had a choice and it didn't really matter either way, you'd always default to the margin account. Again, doesn't mean you have to use your margin, but just having the ability to do certain things is always better. You want more options, not less. Benoit asks, I meant to ask, if I want to follow leveraged without options, what should the distribution be? Yep, there we go. 30, 20, 20, 30. I would increase exposure to the balance strategy and the defensive rotation strategy, and I would not increase exposure to aggressive vol or VB threshold or tactical vol or anything. Volatility, I mean, again, talking about risk management, I keep those at 20%, and it's not a good idea to increase it. A lot of people ask me, well, you've been so successful for 9 years. You've not suffered any drawdowns of any significance. Why don't you just bump up the allocations of those? The reason is you don't have to. You really don't have to. So I would overweight on the two that work best together, which is balanced and defensive, and I would just keep the other ones the same. All right. Last question. Vertical spreads are always a good idea because they are defined risk. And the other benefit to doing verticals, if you're an option trader, is you are far less concerned with volatility, with Vega, right? Vega can be a very surprising little Greek that affects their trades much more than they think. And so whenever you're doing verticals, as long as your strike prices are fairly close together, you're basically eliminating that volatility aspect. And it's a really good, I don't say this to belittle or anything. Trust me, it's not. It's a good entry level option strategy to get into, because it's pretty difficult to get into trouble when you're trading verticals. It's really all about position sizing. And as long as you can see right in front of you the max loss you can suffer, as long as you're okay with losing that amount, then you can't really get into trouble with verticals. So, but just bear in mind that double-edged sword. A lot of people, when they're trading verticals, because they don't like the idea of many, many small wins adding up over a long period of time, they try to get those big wins. What they end up doing is over allocating to each vertical. And that's when you can get into trouble. It can just shock move and you can lose a good chunk of your verticals. So what I would say is verticals are awesome. And the goal of trading vertical option spreads is many, many controlled small victories added up over a long period of time. Don't fall victim to the temptation to try to chase those premiums and bump up your profit. The vertical spread is not a very good, high speculative bet like that. You can't really beat the options market. It is efficiently priced for the most part, and just try to get small wins. Keep everything small and just build slowly, and you're going to be just fine. All right. Thanks, everybody. Hopefully the presentation on VXX gave you a little bit of context into volatility, ETP, decay factors. Just pull up that chart really quickly. These are the decay factors that we talked about earlier in the presentation. The big one that most people will be interested in, I think, is the 5-day, right? 1 day is a little bit hard to conceptualize, but maybe the 5-day, the 21-day, again, that's trading days, so it's a 1 month factor. VXX minus 1.2, UVXy minus 2.1 a week, old TVIX minus 3.1 a week. And then there's the monthlies as well. So thanks everybody for checking out the stream. I'll think of another topic and we will come right back next week. Do the same thing again. I promise I will try to manage time a little bit better and I will let you go sort of closer to the hour 15 mark next time, hopefully. But thanks very much. Enjoy the rest of your day.